So thank you all for joining today. My name is Aymeric Forest. I'm responsible for multi-asset solutions at Aberdeen Standard Investments. Today I'll talk about the concept of diversification. I mean, as investors, we have all grown with Markowitz and other prominent researchers that spend a lot of time trying to convey the message that diversification was good for investors. However, over the last 10 years, diversification has been challenged for various reasons. One of the reasons is very strong returns that equity, but also other types of assets have experienced. So therefore, any attempt to try to diversify your portfolio led to suboptimal results compared to simply owning equities. And if you recall, in the previous decade, in the noughties, it was completely the opposite. It was all about diversification. Buy and hold strategies didn't really work. And in the 90s, it was a bit similar than the last 10 years. And Alan Greenspan talked about irrational exuberance, if you recall. So, you know, it's the same wheel turning and turning, and we talk about the benefit of diversification at different times. However, it's when people give up on the concept that they got hurt. So let's start with a review of the last 10 years, and we're starting a new decade, so it's always good to go back on what happened. So a simple question to you, what have been the best and the worst asset classes of the last 10 years? Those are data provided by a study from Deutsche Bank. So is it the Russian equity market, Nasdaq, S&P, commodity, or the Greek stock market? I don't know if someone wants to, with conviction, raise the hand for, yes?
So the best, I would say Nasdaq.
Yeah, and the worst?
Probably commodities.
All right, good try. It's not the right answer. Who wants to bring the right answer? It's not far. No. You know, when the first one got burned, no one wants to do it. So it's, to be honest, indeed the Nasdaq. But it's a Greek equities. But commodities were close to bottom. And what is quite interesting here is indeed the concentration around US equities. And what you can see over the last 10 years, who benefited? Asset classes who benefited from monetary stimulus, and asset classes where you could find any pocket of growth in an environment where nominal growth has been quite low over the last 10 years since the great financial crisis. So it was concentrated on technology sector, and any attempt to try to do anything else wasn't great. However, for European investors, what was important, and UK investors as well, was the fact that your domestic currency depreciated. So what did you have to do? You had to indeed buy international assets. Russia did well, probably for structural reason, an attempt to improve the problem with inflation, but also the support from central banks. Now, the question is, was the last 10 years normal, a normal phenomena? And if we look at the distribution of the Nasdaq and the S&P 500 compared to return distribution over the previous 20 years, you can see that there is quite a difference. So that's what happened after the great financial crisis, and that's what happened before. So what happened? Higher return and less fat tail. Intervention of central banks helped reducing the risks. The question we have to ask ourselves is it going to be the same in the next 10 years? We do believe that central banks will still remain there to help, but obviously the impact, if you remember 10 years ago, the rates, before the great financial crisis, the rates were around 5–6%. we're not at this level. So the marginal benefit of monetary policy has decreased. And in the meantime, a lot of central bankers, including Mario Draghi, pushed for fiscal policy to be used extensively and to complement the role of central banks. So in this context, we do believe that returns are still going to be attractive, but probably not as attractive as what we've seen over the last 10 years. But we also believe that the tail will probably be a bit fatter. Why? Because we have accumulated excess of debt, and that means a higher sensitivity to the behavior of central banks, higher dependency on government to keep accumulate debt in order to launch new fiscal stimulus policies. We've seen that under the pressure of populism in Europe more recently. So again, we're not calling for recession, for Armageddon. However, what we are calling for is an environment that is going to be probably a bit more volatile. So you may be happy with volatility, buy and hold, continue to buy and hold your equities, but you will be or will have to be ready to accept some spikes in volatility. Could come from political events, US elections, trade war, because trade war is not finished. It's something that will last for the next 10 or 15 years, probably more. It's global dominancy, but also, specific risk like coronavirus we're experiencing at the moment. So positive returns, low single digit, not super exciting. This chart just shows that political risk is likely to remain. And in an environment where you believe that there will still be a bit of volatility, investors are unsure about what to do. And this is why the average level of cash in most of the portfolios are relatively high. Those data are as of end of last year. In the meantime, there's been some of this cash has been invested. We had strong rally in equity in some bond market, a bit of credit. But it is likely to become a recurrent issue. Now, what do you do with the cash when interest rates are very low, like we are experiencing at the moment? Two solutions. Either you have to climb up the risk ladder, you add to credit risk, to equity risk, or you try to find strategies that are diversified, complementary. It could be absolute return strategies. And I'd like to make a pause here. You know us because we've been extremely famous, positively and negatively, on absolute return strategies over the last 15 years. We have one of the longest track record in the market and was managing one of the biggest funds in the market. We believe that, and when we look at what we've done, we believe that we could have done better. And we've been working hard over the last couple of years in order to continue to improve what we do and understand our successes and failures, and very much leverage on this learning process to keep improve what we do for our clients. So I generally believe we are in a very strong position in order to help you in this environment find new sources of diversification, market-independent sources of return to help complement your portfolio. So yield is likely to be an issue in this environment because we still believe central banks to remain relatively accommodative. They will try to rebuild ammunition like the US central banks did. But look what happened. After just 18 months, the market told them, stop. Don't tighten so quickly, whilst their tightening process was extremely slow compared to history. So we still believe interest rates will remain low, which will create additional problems, including in Europe, for people who just want return. So what do you do with your cash? So you could look at multi-asset solutions from different angles. The first one, How can you diversify your portfolio? First one, you can add asset classes. Okay? So you have the traditional asset classes, you want to expand the number of asset classes to alternatives, private markets. What happens here, you may have to take some liquidity risk. And you're probably all aware that there is a high demand for private markets at the moment. But there's been also some cases of liquidity risk being mismanaged in the UK. So it's how to find a compromise, and how do you ensure that your multi-asset portfolio manager takes into account those liquidity risk as they manage their portfolio. A second approach to actively diversify your portfolio is through tactical strategic asset allocation. This is what we call dynamic multi-asset. Here you want to diversify across time horizon and focus on the drivers of your investment strategies. So valuation is a long-term driver, and maybe a tactical analyst will have a shorter time horizon driver. The third technique is to identify idiosyncratic risks, a very specific risk that will, when put together, provide a market-independent source of return. And this is what we do on the absolute return side. And finally, we have the systematic approach, macro-systematic, using alternative risk premia, for example. But you may be aware that houses such as AQR have suffered dramatically. Alternative risk premia have done very poorly last year and the year before. And we believe that one of the reasons is because of bad portfolio construction. The fact that a lot of those alternative risk premia that have become mainstream commodity are exposed to similar factors, such as carry. So we see them more as complementary to equity or credit risk rather than pure diversifier. So what we've been doing on the macro systematic side is a big focus on portfolio construction through collaboration with the University of Edinburgh and a portfolio construction technique that we call dimension. That is proprietary. So within ASI, in order to provide these sources of return, we are organized probably traditionally, I would say. Obviously, we have embedded research. We have the support of our asset class specialists. We have modeling and analytics team, implementation team, and a series of portfolio management teams that are specialized in those different techniques. So, for example, diversified assets to diversify by adding asset classes, leveraging on a liquidity risk premia, or the absolute return team. Altogether, the team has more than 100 members. So it's a big team, and we manage more than 200 billion euros of assets. As I mentioned, the team was also under focus because of the performance of multi-asset and absolute return strategies. I'd like to say that it's been an issue not at company level, but it's been an issue across the industry. If you look at all multi-asset, and that's going back to what I said at the beginning of the presentation. Any attempt to diversify a portfolio over the last 10 years would have led to underperformance compared to equity. So two things. We have to acknowledge that, but we also have to understand that when you need to be concentrated, let's be concentrated. When you need to deploy risk with conviction, let's deploy risk with conviction. And this is what we are doing. We are doing probably better, and we keep improving. It is very important, again, to acknowledge what we're doing right or wrong and develop what I call a culture of continuous improvement. So ASI is also the result of the merger between Aberdeen and Star Life. It brings a lot of resources, especially on the resource side, in order to manage those portfolio. And as I said, over the last few years, the focus has been on the culture of continuous improvement. And this is a very strong message to our client. Going forward, as I said, we need to have conviction to deploy the risk, but also to be more granular. For example, when we think European equities, don't buy the Euro stocks. Think about maybe European infrastructure, maybe a particular sector, maybe a pool of stocks. And this is what we're doing more and more in our portfolio. Instead of using the traditional indices, focus on the deeper diversification, deeper complementarity at portfolio level. A few words on ESG. It's very interesting because over the last few years, ESG has become fashion. However, we've been doing ESG since 1992, integrating it in our processes. Maybe we were not as good in marketing than other houses that don't do much but talk a lot. Maybe we haven't spoken enough. But it's very interesting how we integrate ESG principles in all our multi-asset strategies. We do it at different levels. For example, for gas, we have climate change scenario analysis, risk scenario analysis. We tend to focus on scorecards, and we embed, scorecards, for example, to make an investment decision. You may look at position in the cycle, valuation, earnings growth, discount rate, but also in ESG principles. We have a short Hong Kong equity, not because of the virus, but because of social consideration, income inequality. We have an exposure to a European infrastructure that invests in advanced techniques that would aim to improve the environment in coming years. So we believe it's a source of growth. So this is how we can embed tactically ESG principle. On a structural, more strategic side, we have released a very good paper called the SAA ESG New Frontier that shows how, from a portfolio construction point of view, you can have different portfolios who have the same returns, the same risk, but have different dimension in terms of social consideration, governance, in terms of climate transition. So this is a very interesting paper. Please come back to us if you want more information in this space. Yes. So absolute return. Our aim is not to provide the exact pattern than equity markets. The aim is to provide a smooth set of returns. How do we do that? We can easily basically combine strategies that have positive correlation or negative correlation. And what is very interesting, if you look at the pattern of the returns of a product like gas over the last 18 months, we're not making necessarily money with equity. We're making it, recently we made a lot of money through Australian rates. We could make money through relative value, through some currency. So we try to find very specific idiosyncratic risk, whilst combined will offer a superior risk-adjusted return. And on this topic, we do expect a return of 8% this year. So far we are up 2.5%, so we aligned with our expectations. Last year we delivered in dollar a bit more than 10%, and in euro I think 7 or 8%. But basically the main theme we're focusing on at the moment is, yes, we still believe interest rates will remain low. We also believe that European growth is not going to be fantastic, and you need to be a lot more selective. Where can you find pocket of growth in this space? We also believe that emerging markets, again, you need to be selective. The growth could be more attractive, especially on the earning side, compared to the DM market. And you may have seen countries like Taiwan or Korea benefit from the semiconductor cycle more recently, or the DRAM cycle. And finally, there are some geopolitical risks. We had Brexit, and we have a position on UK inflation. We have the US election. We have also a position on US inflation. Hong Kong. So we have to take into account those idiosyncratic risks as well in order to provide the right return to our clients. Another example of strategies that we run on diversified assets, it's a strategy called dynamic multi-asset. Here the idea is, compared to absolute return, to provide an equity beta, but to try to diversify this equity beta with relative value, interest rate, inflation. So you will have a higher level of beta than a product like GARS, absolute return. Last year, for example, the performance was 15–16%, mainly coming from the equity beta. But on the risk-adjusted side, we offer superior return thanks to the dynamic allocation to those asset classes. And this is the sort of return pattern we offer that is equivalent to equity, but a lot smoother in terms of risk. And we do expect this year 8–8.5% return. The final strategy I just wanted to show you to illustrate how we can help you diversify your portfolio is the diversified assets. So we have a DGF, Diversified Growth Fund, and a Diversified Income Fund. And here the aim is to complement traditional asset classes with alternative assets, such as asset-backed securities, such as real estate, private equities, etc. Here we target 5 to 6% per annum and an income of 4.5%. So again, something that could be of interest to you. And what is interesting in this space, we have specialists that manage very actively exposure to unusual asset classes, I would say, such as music rights. So that's interesting, such as license on pharmaceutical products. So it is not something you will see on a day-to-day basis. However, we have, again, a team of specialists focusing on those asset classes. Why would you buy a multi-asset product? As I say, a year like last year when equity delivered 25–30%, through diversification, we will not deliver this sort of returns. However, we can help diversify your portfolio. We can help your portfolio resist different scenarios, such as a Chinese crisis, such as a trade war. So I do know that last year you may have seen what was the point of having multi-asset product, but in coming years it is something you may have to consider. And you can see that those strategies tend to resist well on the downside. Now I had a question in the past, what if you expect, I don't know, a European crisis, but we will change the structure of our portfolio? So it is very much associated with the probability that one of those events take place. If the probability increases, we change the structure of the portfolio. Just to conclude, we're here to help. We're here to partner. Don't hesitate to come to us, ask questions. We're here to provide advanced level of diversification. There are some decades it may work better than others. But we are focusing on the culture of continuous improvement. If we need to be focused and have high conviction trade, we will do it. And this is probably an improvement compared to what we've seen in the past. But it's a learning process. What is important is to learn for the right reason and keep improving in what we do for our clients. So thank you for being here. If there is any question, I'll be very happy to answer them.